Welcome back to the Executive Brief. I'm James.
And I'm Sarah. Today we are breaking down the JP Morgan 2026 Outlook.
And this is, it's really one of the cornerstone publications for strategic investors, isn't it?
It absolutely is. Formally, it's the 30th edition of JP Morgan Asset Management's long-term capital market assumptions. Most people just call them the LTCMAs.
30 years.
Yeah.
That's a remarkable track record.
Yeah.
It gives the whole report this incredible weight and authority.
It really does.
And for anyone who might be less familiar, we should be clear, this is not about predicting what happens next month or next quarter.
Not at all. This is the long view. The LTCMAs provide the foundational strategic framework. We're talking return and risk expectations over a 10 to 15-year horizon.
And for, more than 200 different asset classes.
That's right. It's the blueprint, really. It's what institutions and, sophisticated investors use to make those big strategic asset allocation decisions around the world.
It's about positioning for the structural changes, not getting caught up in the cyclical noise.
Exactly. And the theme this year is just perfect. It's encapsulated as shifting landscapes and silver linings.
That really captures the tension, doesn't it?
It does, because we are seeing these immense, monumental shifts in the global economic architecture, things that, frankly, were just unthinkable a decade ago.
You mean things like the rise of economic nationalism?
That's a huge one. But also the speed of AI adoption and this massive, and I mean massive, renewal of government fiscal engagement. It's a global reversal of that decades-long trend of austerity.
So fragmentation, technology, and fiscal dominance, those really are the new tectonic plates shaping the next decade.
And they're precisely what we need to structure our deep dive around today.
We have a lot to get through, especially on the inflation thesis and, well, the pretty radical implications for fixed income portfolios.
We do. But first, smart investing requires the right execution. We've partnered with Webull to give our listeners an exclusive deposit bonus. You can claim your free fractional shares by using the link in the executive summary below.
Okay, let's jump right in then. The big picture, the macro outlook. Looking at the headline numbers, the global growth forecast is, well, it's holding steady at 2.5%.
It is.
Which, considering all the complexity and geopolitical headwinds the report details, that number feels surprisingly resilient.
It is resilient, but you really have to look beneath the hood. The engines driving that 2.5% are changing, and they're changing dramatically.
So the top line number is the same, but the components are totally different.
Completely different. The foundations today are certainly healthier than they were, say, after the global financial crisis. Corporate balance sheets are robust, and there's a much greater willingness to deploy capital for investment.
Okay, so that's the base.
That's the base. But what's really sustaining that aggregate 2.5% are two powerful counterbalancing forces, and they're both rooted in these accelerated policy shifts.
All right, let's detail those forces because it sounds like they are the strategic drivers for the next decade.
Okay, first up is turbocharged government spending. The LTCMAs have a great term for it, fiscal activism. Post-pandemic, the political paradigm has just shifted. The whole idea of austerity, which really defined policy in Europe and parts of the U.S. after 2010, that's firmly in the rearview mirror.
It's completely reversed.
Governments are dramatically increasing their spending commitments. They're using justifications like national security or strategic competitiveness to push through massive spending on defense, on infrastructure, and on green transition initiatives.
Which is just high-octane demand stimulus poured into the economy.
It's pure stimulus. And the second force is the accelerated adoption of technology, specifically AI.
And this isn't just because it's new and exciting technology.
No, this is being forced by a macro constraint. Labor scarcity. You have aging populations across developed markets, and critically, you have stricter migration controls that limit the expansion of the labor force.
So companies just have no choice.
They have no choice. They're being forced to turn to technology, to automation and AI just to maintain production and protect their profit margins in the face of a dwindling and more expensive labor pool.
So this tension. You have this massive fiscal spending on one side, meeting this technology-driven efficiency on the other. And that's what's driving this geographic redistribution of growth.
Precisely.
Okay, so let's start with the U.S. It's enjoyed this, this growth advantage for the better part of a decade, but the report seems to indicate a modest erosion of that lead.
That's a key structural call in the report. The U.S. growth forecast is down 20 basis points. It drops from 2.0% to 1.8%.
And we need to be clear. This isn't a call on a cyclical downturn or a recession. This is about the long-term trend.
Exactly. This downgrade is due to specific, enduring policy shifts that constrain trend growth over that long horizon. The LTCMAs pin this squarely on two political choices: higher tariffs, so the move toward protectionism, and stricter immigration controls.
Can you just explain the mechanism there for our listeners? I think people see tariffs as a trade issue, but how do they directly constrain long-term growth?
Well, they create inefficiency and friction. It's that simple. When you impose tariffs, you force companies to do one of two things: reshore production, which is often more expensive, or switch to higher cost, less efficient supply chains.
Either way, it lowers aggregate productivity.
It does, and stricter immigration is even more direct. It's one of the three foundational inputs for economic growth, along with capital and productivity. When you restrict the expansion of the labor pool, you directly restrict potential GDP growth. So this policy mix is creating a lasting constraint on America's long-term growth potential.
An ad structural headwind for the U.S. appears to be a silver lining for another region, specifically Europe. The euro area growth forecast actually rises to 1.5%. That's a pretty stark contrast.
This is, I think, maybe the most surprising finding in the macro section. It just highlights how quickly government policy has pivoted in the Eurozone.
What do you mean?
While last year's report flagged fiscal activism as this sort of nascent emerging trend, this year, European policymakers have, and I'm quoting here, decisively thrown off their self-imposed fiscal shackles.
And the primary example of that is Germany, right?
Yeah, it's Germany. They're planning to rescind their constitutional debt brake policy in the first quarter of 2025. This is a huge deal. It allows for a massive surge in fiscal commitments that were impossible before.
And we're talking about real capital in motion here. I remember from the materials, the commitment for defense and green infrastructure it's substantial. Something like 1.6 trillion euros in combined public and private spending.
That's the scale we're talking about. And it's focused on regional defense, on modernizing infrastructure, and on energy security. These are all long-duration, high-impact investments.
And that spending is so significant that it's actually halving the historical growth gap between the U.S. and Europe.
It halves it. We've gone from a 60 basis point gap down to just 30 basis points, so 1.8% in the U.S. versus 1.5% in the Eurozone. It's a fundamental redistribution of demand driven by policy.
Okay, so it's clear that policy choices, tariffs, immigration, huge government spending, these are the new structural forces. And the biggest consequence of this fiscal dominance and trade friction has to be inflation.
Without a doubt.
Let's move to our first heavy focus area then. Inflation, and what the report is calling the new normal of volatility.
This is probably the most critical section of the entire report this year. It impacts everything else, from equity valuations to bond yields.
So what's the central thesis?
The central thesis is that global inflation will remain persistently above its pre-pandemic trend. The expectation is that it will be, quote, warmer and more variable over the entire 10 to 15-year forecast horizon.
And this isn't just about lingering supply chain issues from the pandemic.
No, this is not cyclical noise. This is a structural change, and it's driven by those permanent policy shifts we just laid out.
And right away, the report highlights a divergence in the long-term inflation picture between developed and emerging markets. What's driving that separation?
That's right. So developed market, or DM, inflation forecasts are all moving modestly higher. We're seeing slight upward revisions for the U.S., for Japan, for the euro area.
And that's reflecting those inflationary undertones of nationalism, tight labor markets, and fiscal spending.
Exactly. Conversely, the emerging market, or EM, inflation forecast is actually revised lower in aggregate. And that is almost entirely driven by downward revisions to China's prospects, which is a fascinating story we can get into.
Okay, let's break down the forces driving this warmer outlook in developed markets first. We can start with the demand-side factors. The most obvious one links right back to government policy: fiscal activism.
Right. When governments dramatically increase spending, the large deficits in the U.S. and new spending in Europe, they're injecting cash directly into the economy. They're stoking demand.
And the risk here is that policy just continually overstimulates demand, especially when economies are already near full employment.
That's the fundamental risk. When your aggregate demand outstrips your economy's productive capacity, the result is always inflation. The report notes that policymakers are now just much more willing to use that fiscal lever to avoid even mild economic slowdowns.
So it's not just the one-off spending, it's the commitment to always spend. It removes the discipline from the system.
Precisely. It shifts the entire equilibrium of demand management. Then you have the green transition. We often think of this as a long-term benefit, but the report points out it creates significant temporary demand-side pressure.
How does building out renewable energy capacity lead to inflation in the short to medium term?
Well, it creates these very specific temporary inflationary spikes. They're rooted in commodity demand and supply chain bottlenecks.
Oh,
The
I
global shift to renewables requires a massive immediate capital spend, a huge increase in demand for key industrial commodities. We need transmission lines, we need batteries, we need new storage facilities.
And until the economies of scale kick in and bring down the
The
costs.
transition itself keeps energy and industrial prices modestly higher. We're talking about a surging, persistent demand for copper, for lithium, for cobalt, even for things like nickel. This intense commodity pressure just feeds directly into consumer prices across all DM economies. It's a structural demand pull on inflation that just wasn't there a decade ago.
And the third demand factor you mentioned is currency-driven, the expected softening of the U.S. dollar.
Yes. For a long time, we viewed the US dollar as significantly overvalued. That was mostly due to the US's relative growth advantage after the GFC.
And while it's still elevated,
It is still elevated, about 10% overvalued in trade-weighted terms, but the LTCMAs anticipate a gradual decline over the forecast horizon.
and for the U.S., a weaker dollar means imports get more expensive.
Right. The cost of imported goods, from electronics to raw materials, goes up, and that is expected to modestly boost domestic inflation in the U.S. It's another signal of this global dispersion of opportunities drawing capital away from the dollar.
Okay, that covers the demand side. Let's pivot now to the supply side. This is where that structural shift toward economic nationalism really shows its inflationary teeth. For decades, we benefited from globalization as this huge engine of disinflation.
It was the single most powerful deflationary force of the last 40 years, no question. Globalization worked by boosting productivity and, crucially, by providing access to cheaper goods produced with low-cost labor globally.
And economic nationalism, with its tariffs and industrial policies, fundamentally erodes those benefits.
It completely reverses them. When you force reshoring or nearshoring of production, you are deliberately choosing higher-cost labor and less optimized, less efficient supply chains.
It's a choice.
It's a calculated decision by governments to prioritize national security and supply chain resilience over pure economic efficiency. But for you, the investor, you need to understand that the price tag for that choice is higher long-term inflation volatility.
And then you layer on top of that the fundamental constraint facing basically all developed nations, labor scarcity.
This is a demographic and a policy reality. You have aging populations, especially in Japan and Germany, but increasingly in the US. And you couple that with these enduring migration restrictions. The result is a constrained workforce.
Which raises the price of labor.
Of course. The scarcity raises the marginal cost. Companies have to pay more to attract and retain workers because the supply is just inelastic. Now, the adoption of technology and AI is accelerating.
But it only dampens the pressure.
It only dampens it. And I think it's important to explain why technology doesn't just erase the problem and therefore the inflation.
Please do.
Because the transition takes time, and it takes capital. Automation requires massive investment in robotics and software, and critically, it requires highly skilled human capital to manage that automation. And that skilled labor is still scarce and expensive.
So it's a race between labor costs going up and technology adoption slowing that acceleration down.
It's a race, and for the LTCMAs, the outcome of that race over the next 10 to 15 years is structurally higher inflation.
This leads us to that intriguing paradox you mentioned earlier, the China disinflationary impulse. The idea that less global trade is actually disinflationary for China itself.
It is a paradox, and it's a key nuance that drastically impacts the aggregate EM forecast. For decades, China built this enormous manufacturing capacity, far beyond its domestic needs.
And that capacity was just absorbed by U.S. and Western demand.
It was, but now, if tariffs and economic nationalism limit that absorption, all that excess capacity has to find a home. And this creates a very painful domestic dilemma for Beijing.
And what are the two potential outcomes of that dilemma?
Well, first, they could try to divert that excess output to their own domestic consumers, but that requires a massive, politically difficult policy pivot to stimulate domestic consumption, something they've struggled with.
And the second, more likely outcome.
The second and more likely outcome is factory closures, corporate stagnation, or just the domestic dumping of goods at ultra-low prices. Either way, it exerts a downward disinflationary pressure inside China.
Which explains why their own central bank has lowered its inflation target.
Exactly. The PBOC lowered their target from 3% to 2%, reflecting these deep concerns about domestic demand. And that is the primary reason the aggregate EM inflation forecast is revised lower, even while other emerging markets might see prices rise.
Okay, so we have these structural forces pushing inflation higher in the West, but central banks are still, at least nominally, targeting 2% inflation. This is where we hit that critical point about central bank credibility.
This is the profound risk that the report addresses head on. And they use a really powerful historical comparison. Before the pandemic, central banks were described as willing but less able to hit their 2% targets.
Because globalization and tech just kept pushing inflation down, no matter how much they eased.
Right. But today, the situation has completely flipped. Now, central banks are theoretically able to fight inflation with restrictive policy, but their willingness to do so is being deeply challenged by the political environment.
And that challenge comes directly from the huge rise in government debt that we've been talking about, the result of all this fiscal activism.
Absolutely. High government debt, driven by these persistent deficits, leads to dramatically rising debt servicing costs. Think about it. If a central bank hikes rates aggressively to hit that 2% target, say taking the policy rate to 6 or 7%,
They inflict massive financial pain on their own governments by raising borrowing costs exponentially.
and ultimately on the taxpayers. This creates a very strong political incentive for them to simply tolerate inflation overshooting the target. Maybe they settle for a persistent 3 or 3.5% inflation rate rather than imposing politically unpopular policies that risk destabilizing the nation's finances. The report calls this the fiscal misbehavior shock.
And that risk of tolerance, that changes everything for an investor. It means the ceiling on inflation uncertainty has been permanently lifted.
Precisely. And to quantify this, the LTCMAs significantly increase the weighting they give to periods of higher inflation uncertainty in their models. They raise this weighting to 12.5%, which is notably higher than the simple historical average of 7% we've seen since 2006.
So this isn't just a theory, it's baked into their long-term models.
It's baked in. It reflects the realization that the primary risk to the system may no longer be recession. It might be policy error that results in sustained high inflation.
So given this high conviction around persistent inflation volatility, the portfolio response is obvious. Investors need real long-term inflation hedges. Let's look at the forecasted returns for these assets, starting with gold.
Gold is singled out as the most direct beneficiary here. Its forecasted annual return is raised significantly by 100 basis points up to 5.5%.
And what's driving that big upgrade?
It's driven by three main factors. First, that explicit inflation volatility we just discussed. Second, geopolitical hedging demand. And third, and this is critical, sustained central bank accumulation.
Right, central banks around the world are diversifying away from the dollar.
They are. They're diversifying their reserves amid geopolitical uncertainty and, concerns over U.S. policy stability. This structural, non-speculative demand provides a powerful floor for gold prices. It makes it a really reliable ballast for a portfolio.
And the second major category of inflation hedges is real assets. This is where you look for tangible collateral that has real pricing power.
Exactly. Real estate, infrastructure, transportation, they all offer compelling expected returns in this environment. They provide both inflation protection and reliable income streams.
They often have contracts with built-in inflation escalators, right?
They do. Real assets generally benefit from attractive starting yields and positive gearing to inflation, often through long-term leases or contracts. For instance, the long-term projection for global timberland was lifted significantly to 6.3%.
Timberland is a great example. Its value is tied to a finite physical asset, and lumber prices track inflation very well.
It's a perfect example. Similarly, infrastructure assets like toll roads or utilities often have revenues contractually linked to CPI. And global transport assets saw their return assumption edge higher to 7.9% because these policy shifts are reshaping supply chains, which creates a need for persistent investment in logistics and rail capacity.
This whole framework brings us directly to our second heavy focus area: recession risk, debt, and the crucial implications for fixed income. Because despite that resilient 2.5% global growth number, the report is signaling that significant risks are still lurking.
They're profound structural risks. While that global baseline remains robust, the LTCMAs use scenario analysis to model what happens when things go wrong. And in that modeling, the report assigns a higher weighting, 15%, to the scenario of a negative demand shock, or recession.
That's up from the 10% historical probability they've observed since 2006.
Right. It's a 50% increase in the assigned probability of a major downturn.
And what justifies that elevated risk weighting in their long-term view?
It reflects two things. First, the higher terminal rate environment we're now in, which just increases the likelihood of a policy error. And second, the underlying fragility that's inherent in these shifting, fragmented landscapes we've been describing. And that fragility is just inextricably linked to debt sustainability.
Right, which is driven by that relentless fiscal activism.
Correct. Governments are pushing up their debt to GDP ratios pretty significantly across the board. Now, the optimistic view is that this investment could boost GDP in the long run.
If it's productive investment.
Exactly, if it leads to capital deepening and productivity gains. But the immediate risk is simply debt sustainability. If your nominal growth doesn't keep pace with the cost of servicing that debt, you get stuck in a feedback loop of higher debt, higher rates, and more political pressure on your central bank.
And this ties directly into one of the key structural risks you flagged from the report, which is the misallocation of capital.
It does. The report warns of the risk that all this new investment, particularly from governments trying to incentivize domestic industries, might just stoke demand without effectively building critical supply.
Can you give us an analogy for that?
Sure. If the government just sends out checks to everyone, that's pure demand stimulus. But if the government invests in a new bridge that dramatically reduces shipping costs for the next 50 years, that's productive supply-side investment. The risk of misallocation is that politically motivated or quickly deployed investments often act more like the former than the latter. They just fuel more inflation rather than creating better long-term trend growth. It's an efficiency problem that's born from bypassing normal market discipline.
And another critical risk you mentioned is the erosion of institutional credibility, which brings us right back to the central bank discussion.
Yes, the report states it pretty plainly. It says the independence of central banks may have passed its high watermark. Now, that is a huge observation for any long-term investor.
Because that credibility is the very foundation of fiat currency and bond markets.
It's the foundation. The political incentive to use deficits to solve every problem, coupled with central banks potentially tolerating inflation to keep debt costs down, it destabilizes the entire financial architecture. When the credibility of your reserve assets erodes, it has implications for your currency, for your term premium, for interest rate volatility over the entire forecast period.
And beyond these structural risks, the report always includes the severe downside risks, the black swan events that you need to plan for.
They detail two specific ones this year. The first is a major cyber attack on financial markets or critical infrastructure. That could lead to a loss of critical data, or worse, frozen markets where trading and settlement systems are just disabled.
The growth shock from that would be immediate.
Sharp and immediate. The second is another pandemic, one with higher communicability or mortality rates than COVID-19. If the labor pool were significantly compromised, it would cause a substantial reduction in long-term trend growth. It would just kneecap global productive capacity.
All of these risks, higher debt, inflation volatility, fragility, they manifest directly in the bond markets through the term risk premia. Let's dig into the consequences for fixed income returns.
The core consequence of all this is steepened yield curves. These risks primarily show up as higher term risk premia and necessary currency adjustments.
Okay, let's define that for the listener. In simple terms, what is the term premium and why is it going up?
Think of the term premium as the insurance payment, or maybe a boredom tax, that investors demand for locking up their capital for a long time, like 10 years, instead of just keeping it in short-term cash.
Right.
In a low inflation, low volatility world, that premium can be very low, or even negative. But when policy is uncertain, inflation is volatile, and the supply of government debt is enormous, investors demand much higher compensation for taking on that risk.
And that compensation is the term premium.
That's the term premium. It's going up because all the risks we just discussed, fiscal misbehavior, inflation volatility, are rising. So investors have to be better compensated for taking on duration risk.
And how is this actually quantified in the U.S. Treasury forecast?
Well, the cycle-neutral yield forecast for the 10-year U.S. Treasury, the UST, moves up 20 basis points to 4.1%. And critically, the term premium, so the spread between cash and the 10-year yield, increases 10 basis points to 120 basis points.
Which is getting much closer to the long-term average.
It's moving substantially closer to the 30-year average slope of 150 basis points. And this higher term premium is a positive for anyone holding duration risk. You're finally getting paid to hold long-term bonds again. As a result, The return forecast for the 10-year UST rises by 40 basis points to 4.6%.
A 4.6% expected return. That's a huge shift from the TINA or there is no alternative era of the last decade. It sounds like intermediate treasuries now project the best outlook they've had since the global financial crisis.
It's a genuine inflection point. The return to higher starting yields and the expectation of steeper curves dramatically boosts fixed income's ability to deliver positive returns. It makes the asset class viable again. But, and this is a big but, this optimism is tempered by a major shift in the investor base.
You mean the traditional price-insensitive buyers are pulling back?
They're pulling back, which makes the market much more dependent on participants who are, well, much more volatile.
Who are we talking about?
We're anticipating reduced demand from the big, historically price-insensitive buyers, specifically the Federal Reserve, which is shrinking its balance sheet, and foreign reserve managers who are diversifying away from the dollar.
So who steps in to absorb all the new debt?
The market will have to rely more and more on price-sensitive investors. Think banks, private institutions, active asset managers. And the LTCMAs warn that the shift is likely to result in greater interest rate volatility for duration assets. You're going to see price discovery happen through larger and more frequent swings in yield.
This heightened volatility brings us to what might be the most fundamental challenge for traditional portfolio construction, the unstable stock-bond correlation. This used to be the bedrock of diversification.
For decades, the entire strategic premise of the 60/40 portfolio was built on the negative correlation between large-cap equities and long-term UST bonds. When stocks fell because of a growth scare, bonds rallied. It was the perfect hedge.
And that benefit is now deeply compromised.
It is. The LTCMAs project that this correlation will continue to drift higher and actually turn positive. It's a small number, forecasted at 0.02, up from -0.03 last year. But the direction of travel is everything.
That shift from slightly negative to slightly positive, from -0.03 to +0.02, it sounds tiny. But for a strategic portfolio manager, what does that number actually force them to do differently?
It forces them to fundamentally change their definition of risk management. That passive diversification benefit is now unreliable. Bonds are no longer that guaranteed all-weather hedge they were for the last 30 years.
And let's clarify why. You mentioned the distinction between different kinds of economic shocks.
Exactly. Government bonds are still reliable hedges against one specific type of shock, the negative demand shock. That's your classic recession, where growth slows, inflation falls, and yields drop. Bonds do great. But they show severe limitations when you're faced with two other major risks. The first is a negative supply shock, like the inflation surge in 2022, where costs rise and capacity shrinks. The second is that fiscal misbehavior shock we talked about, where governments tolerate higher inflation. In those scenarios, stocks and bonds can and will decline together.
Which is exactly what we saw in 2022. The first time since the 1970s that both asset classes fell significantly in the same year.
It was a painful lesson for a lot of people.
So the solution offered by the report is clear. Investors have to look beyond the traditional 60/40. They need to build a 60/40 plus portfolio and actively diversify the diversifiers.
That is the new strategic imperative. You cannot rely solely on core bonds for risk mitigation anymore. You need to incorporate assets that hedge against two distinct types of risk at the same time. You need bonds for the growth shocks, but you also need assets that work when inflation and rate shocks happen.
And this is where real assets, gold, commodities, and alpha strategies become essential.
They move from being optional diversifiers to essential components of portfolio defense. The era of passive diversification is over. The era of active resilience has begun.
Let's transition now to the engine of growth the report identifies, which is technology and the equity outlook. Because despite all the macro volatility we've just described, AI is confirmed as the central engine of productivity.
Without a doubt, technology adoption, and specifically AI, remains the single strongest force driving corporate investment globally. The report has a great quote that captures the competitive imperative. Artificial intelligence will not replace humans, but those who use AI will replace those who don't.
And that fear of being left behind is accelerating capital expenditure.
Like almost nothing else, especially in the U.S. tech sector. And this confidence in measurable gains is now being directly translated into the productivity boost assumptions.
Right. They've raised the total factor productivity, or TFP, assumption in the U.S.
They have. It's up modestly by 10 basis points to 1.0%. And for the listener, TFP is just the measure of productivity gains that come from innovation and efficiency. It's about doing more with the same amount of labor and capital.
And that uplift reflects confidence that AI will translate into real, measurable gains in sectors like finance and healthcare.
It does. And what's notable is that China's TFP assumption was also raised to 1.0%, bringing it in line with the U.S. That reflects their own pivot toward tech-intensive investment to offset their demographic problems.
The analysis also points to this crucial inflection point. We're moving from the adoption phase of AI to the deployment phase. What does that mean for equity returns, especially outside of the big U.S. tech giants?
Well, we're still pretty early in the AI cycle. In this adoption phase we're in now, the U.S. tech giants, the companies providing the chips, the cloud infrastructure, the foundational models, they're the primary beneficiaries. They're the ones with the supersized margins.
But as we move into the widespread deployment phase,
Those earnings and margins will start to normalize a bit. The cost savings and the new revenue streams will start to accrue not just to the providers, but to the users of the technology. You'll see new winners emerge in other sectors, logistics, manufacturing, retail, that are leveraging AI for optimization.
and this is why the report supports international diversification. The extreme index concentration we see now should dissipate later in the forecast horizon as that deployment broadens out.
Exactly.
Now, despite the headwind of high starting valuations for U.S. equities, I think the S&P 500 PE ratio rose from 23.6 to 24.9x this year. The long-term equity return forecast for the U.S. remains surprisingly robust.
It does. The U.S. equity forecast is unchanged at 6.7%.
So you have to ask yourself, if valuations are higher and U.S. growth was downgraded, how is the long-term return estimate the same?
The answer is twofold. First, profit margin resilience driven by all that technology capex. And second, the view that the U.S. will retain its leadership in technology origination despite the geopolitical rivalries. Those profit margins are expected to be much more resilient than historical norms because technology is accelerating cost cutting.
And for overall global equities?
The MSCI ACWI dips just slightly to 7.0%. That reflects the headwind from multiple expansion this past year and that modest U.S. growth downgrade, but the overall outlook remains quite favorable.
So let's pull all these threads together now for the final strategic section. The 60/40 plus portfolio and future investment strategy. The simple global 60/40 stock bond portfolio is still projecting a healthy 6.4% return in dollar terms. If 6.4% is attractive, why is the shift to 60/40 plus so imperative?
Because the future demands greater resilience in the face of those supply shocks, inflation shocks, and fiscal misbehavior shocks we've detailed. While 6.4% is attractive, it lacks the portfolio robustness you need for a world where stocks and bonds can fall at the same time. This is where the alternatives advantage comes in.
Can you quantify that advantage for us, specifically in terms of risk-adjusted returns?
A 60/40 plus portfolio that incorporates a 30% diversified alternatives allocation, so private equity, infrastructure, real assets, hedge funds, pushes the expected return up to 6.9%.
Okay, so a higher return.
But crucially, it also improves the portfolio's Sharpe ratio by a quarter, or 25%.
Let's quickly define the Sharpe ratio for the listener.
The Sharpe ratio just measures the return you get for each unit of risk you take. Improving it by 25% means you are getting a much smoother, safer ride to that higher 6.9% return. The alternatives provide genuinely uncorrelated returns, and that essential inflation protection that core fixed income just can't reliably offer anymore. It's a massive strategic improvement.
This diversification also requires a hard look at currency consideration, specifically the U.S. dollar, which you said remains overvalued.
That's right. The long-expected decline in the dollar has finally started to materialize. It's down about 10% in trade-weighted terms over the last year.
And its anticipated continued weakness provides a tailwind for U.S. investors buying international stocks.
It's a significant tailwind. When you buy international equities, a falling dollar means your foreign gains convert back into more dollars. For non-USD investors, however, it's the opposite. A weaker dollar detracts from their U.S. asset returns. It means they absolutely have to revisit their FX hedging decisions. Currency is now a primary lever for managing portfolio risk and return.
So if we synthesize everything, the fragmentation, the fiscal dominance, the new inflation regime, the compromised bond correlation, what is the ultimate strategic imperative from the LTCMAs?
The landscape is shifting dramatically. It's forcing us out of the comfortable equilibrium we enjoyed for the last 40 years. And this requires investors to maximize diversification across multiple dimensions, not just stocks and bonds, but across currency exposure, alpha generation strategies, and uncorrelated alternatives. The goal is to build portfolios that are resilient to both growth shocks and inflation rate shocks simultaneously.
To ensure you receive these briefings every week, make sure you are following the executive brief.
As we noted throughout this deep dive, the independence of central banks may have passed its high water mark. That's because of rising government debt and the pressure to tolerate higher inflation. This pressure on institutional credibility, well, over the very long term, say a 30-year horizon, it could ultimately challenge the dominance of the U.S. dollar.
The report doesn't foresee an immediate reversal of the dollar's reserve status, though.
No, the alternatives are simply too fragmented today, but they do acknowledge what they call a small but non-zero risk of erosion over decades. And here's the interesting speculation. If large deficits truly undermine central bank independence and fiat credibility globally, then non-traditional assets like crypto, particularly decentralized hard-capped assets, could become a plausible beneficiary from marginal reserve allocation. Not tomorrow, but over the very long term. That's the multi-decade strategic risk that active managers need to start incorporating into their thinking today.